Hi, we're continuing on with the lecture from Chapter 2 that is for Monday, Wednesday, Friday, Class 6. So this is the second part of Class 6 for Monday, Wednesday, Friday. And it's the third part of Class 4 for Tuesday, Thursday. So if you have already watched the first video or videos that are introducing you to transactions, we're just picking up with some additional transactions. So we're up to transaction 10, and transaction 10 is something called prepaid expenses. We have learned about this asset before. So some things you pay up front and they become an asset. Things like your rent, maybe you can pay rent in advance. You buy supplies, right? You're going to buy a whole case of pencils, but you're going to use them over a year, right? Insurance, like my car insurance, I pay 6 months at a time. So those are expenses, and we're going to eventually use them up because they're expenses, but we've paid them in advance. So they're actually an asset, right? They have future value. So that makes prepaid expenses an asset. So don't confuse them with expenses. Like, right, if I go out and I pay for some advertising and I pay $50 to put an ad in the newspaper, that's an expense. It's there. But if I buy some rent up front, right, I pay 6 months of rent up front, well, that's going to have future value. All right, so let's start with prepaid expenses. So transaction 10. On December 1, TuTh Learning prepays 3 months office rent of $3,000. So let's analyze it. The two accounts involved are prepaid rent, which is an asset, and cash, which is also an asset. Prepaid rent is increased with a debit because it's an asset. Cash is decreased with a credit because it's an asset. So we have our increase and decrease happening on the same side of the accounting equation, right? So let's go ahead now that we've analyzed it. We figured out that we're going to debit prepaid expense, rent, and credit cash. We go ahead and do our journal entry. So, you know, that piece of paper that we write on for Monopoly, we're doing our transactions, that's a journal entry. So here's our journal entry for this transaction. On December 1st, we prepaid some rent. So that's our debit, $3,000. And on December 1st, we also paid some cash. So we paid out cash, so that's a credit. The next transaction, transaction 11, payment of an expense with cash. So not a prepaid expense, just a plain old expense. We bought something, paid some cash. So on December 1st, TuTh Learning paid employee salaries of $1,200. So first we analyze it. The two accounts involved are salaries expense and cash. TuTh Learning paid employees for salary, so cash is decreased with a credit. Salaries expense is increased with a debit. So expenses, as you'll recall, decrease equity, right? Because it's stuff leaving the company. It's decreasing the owner's equity. So we decrease equity with debits. Salaries expense decreases equity, therefore we've increased it. So that's a debit. All right, so, and I just memorized, this is one of the things I memorized. Expenses, when we increase them, and pretty much you're always increasing them. You really don't ever decrease expenses. So, except for at the end when you close the account. So we're pretty much always increasing. So salaries, expenses are just always going to be a debit. Just expenses of any kind are debits. So debits come first, so salaries expense, debit. $1,200. Then we paid out cash for that expense, so cash, credit went out. Debits equal credits. And another transaction. Transaction 12, we buy a building and we use a note payable. So we don't actually pay out cash, we sign a note to the bank. On December 1st, TuTh Learning purchased a $60,000 building in exchange for a note payable. So the two accounts involved are building and notes payable. So buildings are assets, right? That's pretty obvious. A building will have future value for the company, and a note payable is a liability, right? Because you owe somebody now, I guess the bank or whoever you borrowed from. Smart Touch Learning purchased a building which increases an asset, so we debit the building asset account. The business borrowed to purchase the building, so notes payable is increased with a cash. So that's the analysis. What accounts are affected? Are they increasing or decreasing? Therefore, is that a debit or a credit? So here, let's do our journal entry. Our journal entry is debit building, $60,000. Credit notes payable, $60,000. We increase the asset and we increase the liability. Transaction 13, stockholder contribution. So on December 2nd, Smart Touch Learning received a contribution of furniture with a fair market value of $18,000 from Sheena Bright. So Sheena has contributed some capital, right? And because this is a corporation, what she gets in return for contributing capital is common stock. All right, so we know we've increased the asset furniture, right? Furniture is something that's going to have future value. You can touch it. It's definitely an asset, furniture. And we've also increased common stock. So the two accounts involved are furniture and common stock. Sheena Bright contributed furniture, so the asset account furniture is increased with a debit. In return, Sheena receives common stock, so the common stock account is increased with a credit, and it increases equity. So our accounting equation remains balanced. So we've analyzed it. Now let's do our journal entry. Journal entry on December 2nd. Furniture account, got a debit, $18,000. Common stock, got a credit, $18,000. Transaction 14, we accrue a liability. So on December 15th, Smart Touch Learning received a telephone bill for $100 and will pay this expense next month. All right, so we got a bill. We know we've been using the phone. We owe $100 for the phone. We're not actually going to pay cash right now, which means we have a payable, right? It's a liability. And we'll just call it utilities payable. We know we also have an expense, right? We've been using the phone. It costs $100. That's an expense. So the two accounts involved are utilities expense and utilities payable. Utilities expenses increased, right? I just said kind of just memorize expenses or credits. They are always, they're debits. So we always just increase expenses with debits. So we debit the expense account. Liability exists because they actually still owe the company. They didn't actually pay it, so they owe. So that's a liability. So the utilities payable account is increased with a credit. So now we've done our analysis, right? We have an expense, which that decreases owner's equity. So that means it's got to be a debit. And we have a liability, which is increased. You increase liabilities with credits. So we've analyzed it. What do? We journalize it. So we got in our journal the date, utilities expense, and a debit, 100. Utilities payable, a credit, 100. So now we've put that in our journal. Next, continuing on, payment of expense with cash. So we're going to pay something out of cash. December 15th, Smart Touch Learning paid employee salaries, $1,200. Salaries expense is an expense, so expenses, just we increase them with debits. So just memorize that. Expenses increase with the debits. Cash is an asset, so we know cash increase with debits, decrease with credits. So we've analyzed it. The cash account is decreased with a credit, salaries expense is increased with a debit, and equity is decreased. So salary expense, debit, cash, credit. Debits and credits balance, we're good. Another transaction. Let's keep practicing. Unearned revenue. Now let's see if you remember what unearned revenue is. On December 21, a law firm engaged Smart Touch to provide e-learning and agreed to pay $600 in advance. So, you may recall There's revenues, which is when we do some work and somebody pays us, or maybe they don't, maybe we get an account receivable, but when we've actually done the work, that's revenue. In this case, somebody paid us up front, but we have not done any work. So it's not actual revenue, we haven't earned it yet. We haven't done the work. So if we owe somebody something, that's a liability. So we actually owe this law firm some training. So we owe them something, so it's a liability. And unearned revenue is a liability. All right? And liabilities increase with credits, right? And of course they gave us some cash. Cash clearly easy to understand as an asset. Assets increase with debits. So the two accounts involved are cash and unearned revenue. Cash is received from customers in advance, so cash is increased with a debit. Unearned revenue is a liability and is increased with a credit. So we've analyzed it, now we journalize it. Cash increases 600, liabilities increase 600, and the name for liability is unearned revenue. Next transaction, 17, earning of service revenue for cash. On December 28, TuTh Learning collected cash of $8,000 for service revenue that the business earned by providing e-learning service for clients. So this is a little bit different from the transaction we just had on 16. We've actually earned the revenue, right? It's actually revenue from providing a service. There's no liability involved because we did it. We don't owe anybody anything. So in this case, we're going to call that service revenue. It's not unearned, it's actual revenue, service revenue. And sometimes we distinguish because some companies have more than one kind of revenue, right? So we have to tell what kind it is. In this case, it's service revenue, and maybe as opposed to maybe sales revenue or rent revenue or some other source of revenue. The two accounts involved are cash and service revenue. Customers paid for services immediately after they were performed, so cash is increased with a debit. Service revenue is increased with a credit and is an increase in equity. Remember how expenses and revenues decrease and increase equity. So revenue is a form of an equity account. And I always remember you increase, pretty much you're always increasing revenue. It's not something you really decrease, right, until the end of the month when you close the book. So if we keep increasing revenue, increasing it. So I remember revenue on the right. And we know credit is always on the right. So this is how I remember this. If I increase revenue, it goes on the right. So service revenue is increased with a credit and is increase in equity. So we've analyzed it, we journalize it now, we know we got cash in, clearly an asset, so that's our debit. Cash increased with a debit, and service revenue increased with a debit. So that's everything we've done for TuTh Learning. Right? So at some point, once you've recorded your journal entries, which you do chronological, right? Did you notice that, how we start and we just went in order as the days went by? We kept recording them. Kind of like when we play Monopoly, we'll record them as the turns happen, right? So it's just, a journal is just all writing everything in chronological order. But that's not that useful if you would want to know a balance, right? You want to, well, what you really want to know is, what's my cash balance? How much cash do I have? How much do people owe me? What are my accounts receivable? How much do I owe other people? What's my accounts payable? So you really want to know balances. So it's kind of hard to just go through a journal in chronological order and pick everything out, right? So what we do is at some point in time, we post all those journal entries to the ledger. All right? So if you look at Exhibit 2-7 in the book, on page 76, 2-7 on page 76, it depicts ledger accounts, and we'll look at that on the next screen. But what you want to notice is that after we've posted everything to the ledger, now we can look at the balances, total them up, and we can see that our equation holds. Our A equals L plus E. Our assets equals 114,700, and our liabilities plus equity equals 114,700. So, if you look at Exhibit 2-7, it shows you all the elements of that equation, and they're represented as T accounts. So what happened was somebody went back through the journal, and every time they saw an entry for cash, whatever that was, if it was a debit or a credit, they put it on the proper side. So on November 1st, there was a 30,000 debit, so they wrote it there. On November 2nd, there was a 20,000 credit, so they wrote it there. So every cash transaction, they posted it to the cash account. Same thing for every account receivable, also. So every journal entry gets posted to its correct account. And this is the kind of thing that happens automatically in a computerized system. But in a manual system, which is kind of what we're learning here, right? Because we're practicing it by hand ourselves, right? So it's a manual system. So you'll see that after the postings, we've got our balance, right? 114.7, 114 equals 114.7. So somebody went back through everything in the journal, and for each line, they posted it under its correct T account, either as a debit or credit. So whatever it was in the journal, if it was a $30,000 credit to common stock, they went to the credit side of the T account and wrote 30,000. If it was a $300 debit to notes payable, they wrote it, so whatever it is on the journal, whatever column it's in, debit or credit, you put that on the debits on the left, credits on the right of the T accounts for that proper exact account. So that's it for this class. Now you should be ready to work the homeworks. Depending on which class you're in, Monday, Wednesday, Friday, or Tuesday, Thursday, you're going to have slightly different homework. So go ahead and find out what homework you need to do by looking on Blackboard and bring that homework to class, and then get ready to work some problems in class. So those are slightly different. So find out on Blackboard in your to-do folder what your homework and what your in-class exercise are going to be. And I will see you in class.